What did you make of this week? It doesn't seem to be in one straight line at the moment.
Well, David, I think this was really a story of bad news is good news is bad news. And this week it was good economic data that raised fears that the Fed may have to continue hiking rates. And that's really all it was to it. But actually, if we go through the data, not everything was that positive, right? Yes, everyone seized on the ISM services, but actually the S&P services PMI wasn't as good. If we look at initial jobless claims, yes, they're lower. The lowest we've seen in a while, and it's been on a trend for a few weeks. But other readings suggest more tepid labor market, right? What we saw from the JOLT survey last week. So I think markets have been concerned because of a few data points. But I've always stressed that not every data point is going to perfectly support the narrative of a disinflationary trend, but we are very much in that disinflationary trend.
We've had a big debate about smooth landing, bumpy landing, hard landing. Where are you?
So I'm firmly in the camp of a bumpy landing. I think it is almost Pollyanna-ish to assume there's going to be a soft landing, which in my opinion suggests that there's no damage. There will be significant damage, in my opinion, in certain areas of the economy. That doesn't mean we're going to go into a recession. I don't think we will. But certainly credit conditions have tightened significantly. There will be pressure, and in fact, we know that typically we see lagged effects of monetary policy. It hasn't caught up yet. But I do think we will see more damage. The good news, though, is that we are also seeing very significant disinflation. So I'm in agreement that we don't need to hike rates again.
Disinflation, are we on a route to 2%? And if so, how long is it going to take us to get there?
I do believe that, and I'm happy you asked that because the Chicago Fed economists just put out a paper arguing that we are actually on that path and that we will get to 2% inflation. Now, it will take some time to get there, but that's okay because, again, typically we see a significant period of time between when monetary policy is enacted and when it shows up in the economy.
What does this say to investors? What do you do in this sort of world of, as you say, bumpy landing? There's going to be some uncertainty, even if it's not going to go off a cliff. What does an investor do?
Well, investors have to understand that there are going to be shifts in leadership because markets are uncertain right now. This week was a perfect example of that. We have a lot of fear right now, but once we get clarity that the Fed really has ended its rate hike cycle, that's when markets can look ahead and start to discount an economic recovery. So that would mean being positioned more in cyclicals, more in smaller caps, but also looking outside the U.S. International is going to be a lot more attractive as the U.S. dollar weakens. And while it has been strong, I do believe that we will see it start to weaken once we have that clarity that the Fed has stopped hiking rates.
Briefly, you're worried about oil. Oil prices did go up this week.
Certainly that's a concern, but it takes time to filter into the rest of the economy to make it into core. So if this is a relatively short burst, I'm not that concerned about it.
Is the Fed going to be a concern?
I don't think so, because the Fed's looking at a mosaic of data. Yeah. And again, this is about a very strong disinflationary trend that I think they can see, and that was supported by what we heard anecdotally in the Federal Reserve Beige Book this week.